April doing triage with folks. So reforecasting 2020, pulling together bridge rounds, helping people think through layoffs and how to manage those. And then now I think folks are in a good spot. And so it's really about, how to accelerate people's strategic positions and to really help people, I think, understand what's out there. So in terms of helping the companies, we did a bunch of stuff around PPP in the US, which is the stimulus package, and trying to help folks figure out whether they were eligible, and for those who were eligible, how to actually get the financing. And then in Singapore, similar situation between the job support scheme and some of the SME and venture lending programs that the government is offering partial risk share on, and helping folks sort of think about how to position themselves for that. But I think going forward, it's really about, okay, now that you've got runway for the next, 18, 24 months, how do you really approach your growth in a smart way? And if you are in a bit of a lull, how do you spend it really investing in the things that are going to help you, as we call it, accelerate out of the turn as business starts to come back online?
Yeah, and I'm following up on that. You mentioned there's a lot of layoffs and uncertainties right now. And, you touched on people having certain financing strategies. Do you think they should be changing their financing strategies looking forward? Or should they still continue to fundraise if that's what they need? Or do you think they should wait out the crisis?
More money is always better than less money. But I think you have to think about the trade-off between like how much time you're spending fundraising versus how much time you're spending on your business. And I think, in the depths of like March and April, it was easier to cut a dollar than raise a dollar. And so, we really try to encourage folks to think about that, and folks to be flexible on, how they think about dilution and valuation. And so, I think for folks who were in Q1 thinking they were going to raise in Q2, they're in a very different sort of landscape. And so if you're holding on stubbornly to Q1 metrics and benchmarks, it might be hard for you to fundraise. But I think, we've been heartened to see that entrepreneurs in general are pretty realistic, and they understand it's better to survive than to, hold firmly to certain valuation numbers. And I think a lot of it on fundraising is really about optimizing for speed, even if it's small checks, over trying to get larger funds to move, and being really clear about what is that money going to do. Because the whole landscape has changed probably since they originally put out their fundraising plan.
Joseph, what do you think of this? Do you think, companies should be kind of halting their fundraising plans, or should they be expecting the same valuation, or should they be expecting, a change in their metrics and benchmarks and everything right now?
Yeah, well, I agree with Xian's, opinion on how we should actually be more defensible first. So, when we talk with our startups, we kind of categorize them strategically in how they should look at their investor pool. Looking at it, and this is a very big generalization, but investors who kind of help them extend their runway, that's number one. And number two, investors who actually raise their valuation. So part of it is that they have to have the right fundamentals. Part of that is cost cutting so that they can have a proper, runway extension. But beyond that is that they have to have a proper leverage point to say that, okay, they don't want to be talking with investors when they only have a 3-month runway, because investors will turn it around and say that, we want special terms in that manner. That would actually, kind of hit, their valuation plans. But then at the same time, they have to be realistic about it. So there are different types of investors that can be a little bit more strategic, that understand, the growth potential, because they are operating within an industrial environment there. And to, yes, give them perhaps a little bit better, different from, Q1 type of financing metrics, and to look at it more from, a defensibility measure, to take, a certain position where that it can ensure their runway can be longer and operationally more solid. So they won't be running around begging investors going forward. But once they secure the position and have a very clear milestone to set out to, other investors that can actually raise their valuation within their current investor pool, and that's when they should actually roll it out. But then I would look at it as a 2-step plan. And it's not to kind of, refocus on one thing or the other, but it's to recategorize first.
And, obviously right now, people aren't meeting up in real life, face-to-face right now. Are we going to see a trend kind of going forward that deal making might be made, virtually, things might change, post-COVID? What do you think, Joseph?
Yeah, I see that, especially with our startups, we operate quite internationally with North America and in Asia as well. And quite a lot of startups themselves are quite, I would say, comfortable, but it's always on, the first part, knocking on doors, getting to know, the investors and getting to know the investors takes a certain amount of time. The startups themselves need to be much more prepared, especially in early stage, investor decks, the data room, so that investors can evaluate much more clearly. Because we see a lot of charismatic founders that can operate pretty well on a bullish market. But in this situation, when you actually, have to interact through Zoom, that's much more difficult. Your fundamentals have to be down, in black and white, so that people can evaluate you much more clearly.
All right, let's look at loans, Jeff. What is the process for startups borrowing from a bank, and how will they be assessed now? Are interest rates? What are the interest rates looking like for them? What are the metrics when startups are going to a big bank like HSBC? How are they being evaluated?
Right. I think definitely we have been receiving quite a lot of inquiry from startups. I do see this special moment as basically a silver lining of the pandemic situation, whereby startups start to pay more focus and attention to their financial and cash flow management and their financial health. It would be definitely healthy for business to review their payables and receivables in order to plan ahead to improve their financial situation as well as the operational efficiency. In terms of what are the support from the bank that can actually help them to sail through this difficult time, I would suggest for short-term financing need, the solutions are actually rather diversified, including commercial credit cards that could be for online purchase, cloud storage, digital marketing. It works just like a credit card, but in the name of your company, so that your nominated staff share the credit limit of the company. There are also working capital financing solutions for daily expenses and trading as well. So basically, in general, account conduct, credit track record, as well as financial transparency are the keys in terms of the credit assessment. So whether if you pay your bills on time or have sufficient balance in your account to honor a check, that also contribute to your account conduct. Depending on the complexity of the solution, we will also assess the financial strength, business outlook, as well as the industry outlook of your industry as well. So for startup, sometimes we do have some simple package lending solution available to them. So basically requires no collaterals or detailed analysis of their financial standing. The interest rate, basically we will take into account of various metrics, including financial standing, facility structure, collaterals and account conduct and track record, basically assessed on a case-by-case basis. Generally, here in Hong Kong, the interest rate for unsecured lending without financial submission will range between 8% to 10% per annum. It's also worth noting that the practice here in Hong Kong may vary from other markets. Say, for example, personal guarantee is often required here in Hong Kong. This is to demonstrate the principal commitment in the business as well as for the repayments. So additionally, legal opinion will be needed if the guarantor is not a Hong Kong ID holder.
Xian, what do you make of it? What do you think of startups taking on loans? Do you think this will affect how you evaluate a startup going forward when you want to invest in them?
I think it really depends on the startup, and what's the status or stage of their business. I mean, obviously, debt is at the top of the preference stack above equity, and so I think that's something to consider if you're investing equity into a highly indebted entity. What do you think are the likelihood that you're actually going to have some upside return once the debt gets paid off? But in general, I think, the debt thing is a hard thing because debt as an instrument, as it's traditionally structured, is pretty hard for folks who are in the early stages of building a business. They don't have a reliable income stream. Technology businesses, unless you're in some sort of hardware manufacturing, don't have a lot of things to collateralize. And I think the PG that a lot of Asian banks ask for is really hard. And so, you do see sort of venture debt types of structures where there isn't a PG, but those are predicated generally on having raised a fresh round of venture financing. So it's like an embarrassment of riches. Not only have you raised your venture round, here's another $1 million, of venture debt or whatever. And that's a pretty small category of companies that are eligible for that. I would say that if you look at North America and the Valley, there's a much richer ecosystem of venture debt providers. Of course, like the lighter capitals, the clear banks of the world, who are providing different forms of debt-like financing. But I think these structures tend to be tough unless you have at least some sort of repeatable sales motion or marketing spend that somebody can underwrite against. Because otherwise, like venture debt, you're basically underwriting the fact that they have venture investors' money already in the bank. So you're higher up in the cap structure, you're gonna get your money back. But I mean, I think that there is room for people to do it for things like invoice financing, right? If you're just trying to work through a working capital issue and you can do sort of invoice financing, and I've seen a number of people take advantage of that, short-term stuff that you think can like tide you through until markets come back and you can go back to sort of equity fundraising. I think those are definitely options for people. And I would say that often startup founders are not as savvy about those financing alternatives because they don't necessarily come from financial services, and some of this stuff like factoring is like very old school types of instruments, but people coming from tech might not think about those. And then I think the last thing I always tell people is like the best money is customer money. Like go sell something that people want. The rest of us are just kind of along for the ride. But yeah, it's a tool in the toolkit, but I wouldn't use it lightly.
Definitely, everyone's looking for ways to survive right now. And you did mention, the best way to make money is to sell something the customers like. And on that note, Joseph, we've seen a lot of companies making pivots during COVID. Maybe not exactly their core products originally. Some of them are introducing lines like product lines like testing kits. Others like online education platforms are obviously booming right now. I know you and Xian both have young kids at home. Homeschooling right now must be quite a handful. We got a lot of grocery delivery services rolling out right now by a lot of companies that might not used to be in this sector. What do you make of this? Do you think it's a short-term solution? Do you think this could bring something really big, a great change for these companies, or what do you make of it?
I mean, I look at it like this, the needs of COVID is very serious and also very immediate. And what that means is that there are going to be a lot of competitors that are going to be addressing specific need, whether be it PPE, whether be it vaccination or antibody testing, etc. The problem is that you're looking at competitors now are also pivoting, not just only in the startup space, but also in the well-funded, well-established corporate space as well too. Question is when these startups start pitching to us that they will be pivoting, we'll be benchmarking not just only against other startups at a similar stage. How long do they need? How much capital do they actually require if they go out of mandate in that way to be competitive there? So again, we look at it. We don't want these startups to look at the opportunities in COVID at a 1 year horizon, but it's still maintaining that 5 year horizon. Now going back, this is use example even on public market side is people are investing in Gilead and remdesivir. It's not exactly yes, there may be that chance, and we're going to look at it on the public market side. But the fact is that there will be set pricing in which the margins that will be designated by the private side will be much more hard to capitalize on. I would say a protected industries if they were granted clinical research, what's it called, acceleration in that manner too. So there's a lot of regulatory hurdles, during and also afterwards that they also have to jump through in order to actually understand and that can position themselves competitively there. So again, is that don't just approach investors because your product can be addressing COVID right now, but how would it be competitive 3 to 5 years or even beyond, and how do you position yourselves appropriately going forward? Because again, as an institutional VC, we don't look at short-term opportunistic plays. If that's the case, we'll be looking at public markets.
And Xian, are there any certain technologies or products that you think that we should be looking out for in coming year, 2 years that really will be coming out of COVID crisis kind of as winners per se?
Yeah, it's an interesting question, and I would agree with Joseph on the short term versus the long term. I think in the short term, what you see is basically customer acquisition costs have gone down in certain sectors because suddenly there's a huge demand for things that you used to have to work really hard to try to sell people or educate them on, and then the question is, can you capitalize on these things to turn them into real LTV and big sustainable business going forward? And so I think it'll be interesting to see how the telehealth players like turn out after this, right? Because you have this moment in time where like everyone is open to it. People are changing regulations for it. Like in the US, they actually changed a bunch of licensing requirements around state by state into national, because telehealth, of course, by definition is national. But it's sort of like, what do you do next? And I think for folks who can really capitalize on these moments in time, I think in 2 or 3 years, you'll kind of see that a bunch of their momentum was built out during this period. But in terms of like core technology, I think I have a hard time believing that if you just started something in the midst of COVID as a reaction to COVID that was kind of tangential from your prior sort of strengths or assets, that this would suddenly be like instantly successful. And so I think of COVID more as like a small focus period by which people can acquire cheaply. And then I think we kind of have to see how it plays out. The one thing I do think is interesting, at least in Southeast Asia, though, is, and I'm kind of curious what Joseph thinks about this, is people have always said, oh, SaaS doesn't work in Asia. Asians don't pay for software, and Asian corporates are just really backward. And we're basically in this like living experiment, right? Where we just said, okay, everybody work from home. Like, I don't care how you do it, just do it. And so you've seen basically like I think an acceleration in adoption, and it's really janky, right? But everyone's being forced to use it. So I am curious if someone really tries to build like a local SaaS player to address, some of these opportunities, because the sales motion is quite different, right? Like people here don't self-serve as much or as well, but it doesn't mean that they don't need software. And so that's something I would be kind of curious about, because at least for Singapore, even though our circuit breaker, so-called, is about to end in June 1st, the guidance I think so far has been, still work from home if you can. And even if you're going to go to the office, employers are asked to do it at limited capacity so that you can observe social distancing. So I think there's going to be this sort of bunch of people stuck working from home for quite a while, and companies are going to have to adapt and have tools to do that.
Yeah, and on that note, companies adapting, especially big corporations like HSBC, Jeff, we're wrapping up our, core questions now. We only have 5 minutes left. Really want to hear what you think, how HSBC has been adapting, how it will be going forward. Have you seen changes when it comes to HSBC approaching the startup ecosystem here in Hong Kong?
Yeah, definitely. I totally agree with Xian on the digital adoption in the COVID situation, whereby we are actually seeing quite a lot of corporates, being our very traditional customers, are very much interested in actually taking up new solutions and ideas when working remotely. I think HSBC definitely will be a role to play, whereby I think, first of all, it's the connectivity as to how to connect startups with all the ideas and connections, ideas and also new thinking and creativity, how to connect to the traditional economy whereby they are still working on papers, on Excels and things like that, how to adoption of SaaS model or whatever, or new ideas in terms of their business model. Definitely, we are doing quite a lot of that kind of connection through partnership with investors or government organizations such as Hong Kong's Science and Technology Park, Cyberport, and all that. We are seeing a gradual improvement in such adoption. Secondly, I think from a corporate perspective, whereby HSBC is also proactively looking for solutions for us to adopt to improve our customer experience as well as the partner experience, whereby we want to improve our digital and innovation assets such that when customers actually approach HSBC for our service, we will be aligned to basically to what is out there being offered at the moment. Say, for example, we will be working on quite heavily investing into APIs and all that, ensuring that we would be having the capability to integrate with SaaS service provider and potentially an other service provider, so as to provide a seamless customer experience to our own customer base. So there are many things that we are doing right now. last but not least is the education piece. I think it is also very important, as you have rightly pointed out, Grace, that I think corporates would have the corporate social responsibility to actually to educate the wider SME population in relation to adoption of technology or help them to go through the digital transformation journey. So we do have a lot planned in the second half of the year for that as well.
Thanks. Thanks for sharing that information. All right. Thanks so much for the simulated discussion. Those were our planned questions. And going forward, we have 3 Q&As that we gathered from the internet that were submitted before the webinar went live. So first one is for Jeff, actually from Ruben from Victory Cloud Computing. What are your suggestions for meeting new people to establish trust during a time of social distancing? I think we touched on that a little bit earlier as well, but yeah,
yes.
Love to hear your thoughts.
Yes. I guess during lockdown, we are not meeting less people, just that we are not meeting people physically, right? In the past few weeks, I almost had at least a webinar a day or 2 webinars a day, talk to people in interaction like this today. So it's still a very good way to meet. Even better if I have a glass of wine in my hand right now. As I've mentioned, we have been working on a digital platform to help connecting businesses as well as providing business insights. So we have recently launched a platform called HSBC Vision Go, which is a new way to meet people. As it can be an additional channel to distribute and promote business events or business insight to basically HSBC customer and beyond. So I guess that platform will be very useful for Ruben to actually to connect to business community. Actually, beyond the startup world, we are well connected to SME customers as well here in Hong Kong. And they are not only from Hong Kong, but international because of the fact that Hong Kong is a very international city.
Thank you, Jeff. The question for Xian is from Elizabeth from Advanced AI. Do you think data-driven mechanisms can be used as significant tools in venture capital?
Yeah, for sure. And I actually think that, for all VCs talk about like investing in future of technology, VCs don't actually use that much technology themselves. Like the biggest VC advance is like using a CRM, right? Like if everyone's like really excited that they have that. I think the question is like for data, which is like, this is always the problem for most investors. And, I think Joseph comes from quant research, right? Which is, well, what's signal and what's noise? There is so much data out there, but what's actually going to impact your investment decision? And what's useful for people to actually give you? So I think we have more tools than ever to see signals in terms of, hey, I can look at Facebook spend, I can look at the ROAS on your campaigns, I can look at velocity, I can look at traffic, all that sort of stuff. You can do that. But is that the difference between like a 2x and a 10x or a 2x and a 100x? I don't know. Right. And is it, there's a whole school of thought, which is like, actually, it really depends much more on the founder and their characteristics. And then in that case, it's like, well, what data would you collect that would be useful to you? So I think it's like it's a yes and, right? So I don't know that we're going to be replaced totally yet by, just a algo that's going to pick companies to invest in. But I do think there's room for a lot more data to come into decision making, to be part of that conversation, which is just to like benchmark it. And you've seen experiments in this. So Social Capital has their like 8-ball. They talk about like capital as a service. Even the Clearbanks of the world sort of trying to do that in e-commerce and SaaS. So there's room for it. And I think we do need to get to the next level of evolution beyond sort of the cottage industry, artisanal investing that we do. But I think it's a hard problem.
Joseph, what do you think of that? Like, do you think there's a solution to this?
Well, I look at it like this, like, coming and looking at, quantitative research. We believe in informational efficiency and we utilize that, but it's not just only about that, but you can operate there, but only on a marginal scale. And if you can beat out the market, that's where it happens. Now, when you talk about seed stage and early stage investment on venture capital fund side, is that informational, it comes down to the arbitrage opportunity differentiation factors are much higher, but then the information flow that you have and the signal to noise ratio is much lower as well. So that's also we talk about investment alpha. How does it really work in the venture capital side? Well, if you look at it, is that what are you benchmarking against? Are you benchmarking against vintage other vintage funds in a similar year and you're outperforming the market? Are you comparing against market beta? In the public markets, in the industries that you're benchmarking against, it's all very different in that manner. So the tools that we use, is it going to be incrementally more efficient? I believe that, yes. But then I still believe we have a ways to go, just as Xian said, is we have a ways to go on a qualitative side, especially on information flow. Now, being based in Hong Kong, and we look at, the markets, in US, in Canada, in Japan, in China, it's all very different. And we look at it, using different tools. Some of it being, relationship based, and how do we document that word in Microsoft Word? How do we look at it on a, looking at different factors, against public market in a medtech space? Then we start using, perhaps anywhere from Excel to TensorFlow and all that to say that, hey, these models actually work. And then so from that angle is that there is definitely room, but is COVID going to make us change in how we assess it? I think it's not going to be that much of a difference. There's going to be ongoing momentum as we become more and more reliant on quantitative tools to decide on how we should invest. But I think that'll trickle down more from hedge funds, private equity, growth stage, and then these VCs or early stage VCs probably won't be implementing that quickly in that way, even though I think we need to.
Thank you. So we got one last question from the participants. Joseph, why don't you take a crack at this? It's how fast will the investment scene rebound? Will we see a capital influx after QE like we did after the 08 crisis? Would financing in Asia rebound faster this fall/winter compared to the rest of the world?
All right, this is $1 million question because I'm sure everyone wants to know that, and you'll make a lot of money from there. So again, take everything with a grain of salt. I'm just one person. So what I look at it is like this, again, I'm going to be a little bit more granular and try to look at it and say that, okay, within the VC space, and comparing against, where will be a capital be coming from, and how do you actually approach it from that angle? Like many things, we should kind of look at the opportunities, not as a macro side, you look at it as a macro, as a benchmark indicator, and then we drill down into the opportunities there. So I'm gonna look at Asia as being, kind of a nascent, market for venture capital investment compared to that of North America. And so what we see is that, the market for venture capital investment has been quite bullish over these last couple of years. And therefore, investors coming from the angel side, either whether be it from the ones that actually have a lot of experience or the ones that want to kind of transition into kind of an angel role, and also corporate investment have been growing. Now, with COVID happening, is that everyone needs to kind of shore up their assets and tends to be a little bit more risk adverse. And so look at it from the angle is that from a startup perspective, is that you want to kind of develop relationships with institutional VCs that have a clear mandate on how they want to invest their capital, and they need to deploy specifically to their mandate in startups in that way. Now, here in Asia is that we have been experiencing the recovery process more advanced than that of North America, and so therefore we just have a little bit more heads up, and therefore we have cleared clean up our own house a little bit more quickly. Therefore, we can deploy more quickly. The question is going back is that will there be a rebound? Now, I'm going to set these limitations in the venture capital startup space. In Asia, I would say yes, there will be coming from inflows that have already been set up and allocated for early stage startup investment from Asia, just because we're ready to restart more quickly. Now, for the startups that already have investor pools from say the angel and corporate side, I'll be more leery of it because there's much more complexities tied into their own assets that are not pre-allocated specifically for startups in that way. So I think there'll be a rebound, but ultimately is that it's still a buyer's market. It won't be as bad as what is right now, but I think that's more the reason why startups need to reposition themselves and have their fundamentals down pat so that it can communicate clearly with institutional VCs.
Thank you, Joseph. Jeff and Xian, do you have anything to add to this? The $1 million question.
Well, there's been a lot of funds that have been raised in the last 12 months that are, Southeast Asia focused. So there's a fair amount of dry powder. And I do think that on a relative basis, it does seem that, we're getting our act together a little bit ahead of some of the Western economies. And so you may see more inflows there. But I don't know. I mean, people are getting deals done remotely, right? There's Liberty and Telefonica got a $39 billion deal done over Zoom. And so I think people will adapt. And I think our response to COVID matters, but I don't know whether it matters more or whether you'll see it happen faster than the fact that our ecosystem is one nascent and still has a way to mature. So fortunately, 10-year fund life cycles. So, I think, Grace, the advice is spot on. It's just focus on fundamentals, make something that people want to pay you for. You didn't build a business. You didn't start a business to raise money, basically. You started a business to start a business, right? So understanding investor sentiment is useful, but I think understanding customers is better.
Great, thank you. Jeff, maybe a last comment from you, and then we're going to wrap up.
Right, definitely. I don't have an answer to that $1 million question, but from a bank financing perspective, definitely, as I've mentioned earlier, I'm seeing very positive trend in terms of the ownership of the co-founder in actually building very good financial health, and that from a banking financing perspective would definitely help us to actually lend more against the startup kind of a business model, as well as with the return of the economy, then potentially we would have much more appetite to support this startup, despite the fact that maybe they are still rather in their very early stage.
All right, thank you, everyone. Thanks for your time today. Stay safe, stay sane.
Thank you.